Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of AT&T Inc., ticker symbol T. We're looking at AT&T today as a subscriber request. Currently, the business is down 19% over the last year. They're trading for $19.83 per share. This decline in their stock price is including their Warner Bros. Spinoff. That happened back in early 2022 when AT&T's Warner Brothers Media was merged with Discovery Inc. Based off of shareholder ownership in AT&T, shareholders did receive shares in that Warner Brothers Discovery business. But with the company being a standalone public business, AT&T's main ticker did see a decline in their share price. Over 5 years, AT&T's stock price is down 47% overall, so they're declining at a rate of 12% annually over this time. Over 10 years, their stock price is down 43% overall, declining at a rate of 5.5% annually. And going back prior to the global financial crisis, over the last nearly 18 years, AT&T's stock price is down 18.5%. It's been declining at a rate of 1% annually. Keep in mind, though, that AT&T does pay out a significant dividend, so actual returns to shareholders would be positive still. Currently, AT&T pays out a 5.6% dividend yield, and over the past 10 years, AT&T has had a median dividend yield of 7.2%. So their dividend yield throughout this entire 18-year time period would be in addition to this compounded annual return, likely resulting in positive real returns for shareholders. The business is trading snugly between their 52-week high and their 52-week low, about $5 off from each. Though there's not much short interest around the business, AT&T is an extremely large business. They have a $141 billion market cap, and they have a ton of debt as well. The business has $160 billion of net debt, so they have more debt than their entire market cap. For more background about AT&T, the wireless business contributes about 2/3 of AT&T's revenues following the spinoff of Warner Media. The firm is the third largest U.S. wireless carrier, connecting 70 million postpaid and 18 million prepaid phone customers. Fixed-line enterprise services, which account for about 20% of revenue, include internet access, private networking, security, voice, and wholesale network capacity. Residential fixed-line services are about 10% of revenue, primarily consisting of broadband internet access service. AT&T also has a sizable presence in Mexico, serving 22 million customers, but this business only accounts for about 2% of its revenue. The firm still holds a 70% equity stake in satellite television provider DirecTV, but does not consolidate this business in its financial statements. So the company was formerly known as SBC Communications Inc. and changed its name to AT&T Inc. in 2005. AT&T was incorporated in 1983 and is headquartered in Dallas, Texas. For our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of AT&T based off of their business fundamentals. This analysis is an evolving and improving process over time. It also serves as an opportunity to learn in public. So with that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. AT&T has earned pretty stable, pretty steady returns on capital in the mid-single digits. Through the company's most recently reported earnings, in 2022, AT&T earned about 7% returns on capital, which was down slightly from 2021. On average, AT&T is earning about a 7% return on capital. That's just half of that 14% benchmark we're looking for, and these returns are more in line with a typical business. So the reason we're looking for 14% or higher is because the average publicly listed business earns about a 7% return on capital, and over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, and these business returns are going to be captured here by return on capital. By looking for a benchmark of 14% or higher, we could have potentially built in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. However, AT&T earns just about average returns on capital, and so this is an X to start things off here on metric number 1. Next up, for metric number 2, we're taking a high-level overview of the growth of their business, so we're looking for revenue, net income, and free cash flow growth over the last 5 years. This metric is all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of these is down, this entire metric will be an X. Over this period, we're really seeing a decline in AT&T's business. Their revenues are down 30%, although much of this is from spinning off Warner Media. Their earnings are also down significantly. They were positive in 3 of these years, and they were negative in 2020, and then they're quite negative in 2022 as well. In 2022, the company took a $25 billion impairment of goodwill. And then at the same time, the company's free cash flows are down 45%. This is a decline in growth across the board here for AT&T. meaning that this is an X here on metric number 2 as well. Next up, for metric number 3, here we're looking at the business from the perspective of an individual shareholder in AT&T by looking for earnings per share growth over the last 5 years. Again, we learned that their earnings were negative in 2022, meaning that their earnings per share are going to be down. However, we also want to look at what they've done in terms of their shares outstanding. And that's important because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. And so over this time, AT&T has diluted existing shareholders by about 5%. By issuing new shares over this time, AT&T has decreased existing shareholders' ownership percentage in the business, which ultimately decreases their percentage of the business's profits. So with more shares outstanding and their earnings being down over this period, this is going to be an X here on metric number 3. One thing to mention is that even with their $25 billion impairment of goodwill, even if we were to adjust that and exclude that from their earnings would still be down from where they were in 2018. So far, things aren't starting off so hot for AT&T. We are 0 for 3 through our first 3 metrics. Next up, for metric number 4, we're looking for something similar. So here we're looking for free cash flow per share growth for the business. So previously, we learned that their free cash flows are down 45% over this time frame, and the company has issued additional shares, meaning that their free cash flows per share are going to be down as well. AT&T is producing just about a little more than 40% of the free cash flows per share that they produced in 2018. And so this is another X here on metric number 4. Next up, for metric number 5, here we're evaluating how the business is utilizing leverage. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. So we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that the business has produced over the last 5 years. On an absolute basis, AT&T may have the most amount of leverage of any business in the world. Over this period, their leverage peaked at about $187.5 billion, which again, in absolute terms, is just a crazy amount of money. They have brought this down somewhat, both by trying to pay off their debt and through their spinoff. Currently, they have about $151 billion of net debt. However, over this time, AT&T has only produced $117 billion worth of free cash flow. So because of the scale and size of this business, while that is, again, in absolute terms, a huge amount of free cash flow, relative to the net debt that the company is employing, that doesn't look like their free cash flows would be able to support this debt load. And their free cash flows have come down quite dramatically over their last fiscal year, falling by more than half over that time, both because of pressure on AT&T's existing businesses and again because of that Warner Media spinoff, meaning that this is an X here on metric number 5, even with their reduced debt position. So it does look like AT&T is utilizing quite a large amount of debt in their business, both on an absolute and a relative basis. So if this debt load is a potential concern for you, you'd want to dig into the company's filings. They would break this out in more detail, and you'd be able to dig into the finer nuances of this and understand exactly how this debt is structured, what rates is it at, and when these debts mature. So again, you can look into the business's filings to learn more. Then last but not least, our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will potentially give us a slight risk premium to the yield of the 10-year treasury and potentially offer us a reasonable starting point for a valuation of AT&T. So right now, AT&T has about a $301 billion total enterprise value, and we're using their enterprise value because it takes into account both their market cap and their net debt position. So it's going to give us a perspective of the economic reality of AT&T's business that's going to be more in line with what we would expect if AT&T were a private company. So we learned in our previous metric that AT&T has produced $117 billion worth of free cash flow over the last 5 years, meaning that in an average year, AT&T produces about $23.3 billion worth of free cash flow. So when we divide their $23.3 billion of their average free cash flow by their $301 billion total enterprise value, that gives us more than a 7.5% average free cash flow to enterprise value yield for the company. So coming in all the way at the end here on our final metric of the day, AT&T gets its first and only check because on a historical basis of their free cash flows, it does look like the company would be potentially interesting to dig in and look at, as it does look like the company is offering a potential slight risk premium based off the yield of the 10-year treasury. Worth being aware of, though, is that their free cash flows over their last year are down quite significantly from what they are historically. So AT&T has produced $12.4 billion worth of free cash flow over their last 12 months, which also falls in line with their last fiscal year. So to get a current free cash flow to enterprise value yield for AT&T's business, when we divide their $12.4 billion of their last year's worth of free cash flow by their $304 billion total enterprise value, that only gives us about a 4.1% current free cash flow to enterprise value yield for the company. So while that is slightly above the yield of the 10-year treasury on a current basis, that would be below that 5% risk premium we're ideally seeking. So their average and their current free cash flows are split on either side of this 5% benchmark we're looking for. Then as a bonus, here we're looking at AT&T's dividend profile. So right now, AT&T pays out a 5.6% dividend yield, which again is a yield that's significantly higher than the yield of a S&P 500 ETF. However, it's important to not make mistakes by blindly chasing dividends because people do that all the time. Instead, you want to dig in and look at the underlying fundamentals of a company and determine whether their dividends are going to be healthily supported by their abilities to produce free cash flows in the case of AT&T's business. So thankfully for shareholders, in all 5 of these years, AT&T has supported their dividends with their free cash flows. However, AT&T did cut their dividend by quite a bit in 2022. Given the high debt loads that AT&T employs in its business, it's likely a prudent capital allocation decision to be devoting more of these free cash flows to paying down their debt instead of paying out a huge dividend yield, as it does look like the business, especially if their free cash flows don't rebound to where they have been at historically, could have the potential to struggle under such a high debt load. So even though their dividends are supported by their cash flows, management likely saw fit to use their cash flows in other ways. This is because free cash flow is really the lifeblood of any business, and a business can use its free cash flows to pay down debt, pay dividends, buy back shares, make acquisitions, or reinvest back into the business. So if you're potentially interested in AT&T for its abilities to pay out dividends, you'd want to read through the business's 10K and also follow along by reading some of the transcripts of their recent earnings calls to dig in and understand management's character and their competence when it comes to capital allocation. Then everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze AT&T, which takes us on to using a discounted cash flow model to come to a potential fair intrinsic value for AT&T Inc. So a discounted cash flow model is just like any other model in any other discipline. Its outputs are going to be sensitive to its inputs. So here we're starting with an average of AT&T's free cash flows over their last 3 years. Then we're using historical growth assumptions based off how the business has grown their free cash flows dating back all the way till 1990 to project these out into the future. So it's up to you to do your own homework here to determine whether or not these are going to be potentially accurate and applicable going forward for AT&T to give that baseline projected estimate over the next 20 years. So assuming a growth stage for their average free cash flows where AT&T grows their average free cash flows at a rate of 4.6% annually for the next 10 years, then assuming a growth stage for the 10 years out after that where they grow their average free cash flows at a rate of 3% annually. If we add in an approximation of the company's tangible book value, which is actually negative in AT&T's case because of their high debt load, and we were ideally seeking a 15% rate of return from the business, which this would be including their 5.6% dividend yield, and this is also the rate of return that Warren Buffett is ideally seeking from his investments, in addition to his margin of safety requirements. If we were to do that, it looks like a potential fair value for AT&T would be about $11 per share. That would be about $9 below what their current stock price is. So based off today's valuations of the business, and if these assumptions are going to be accurate, it looks like AT&T's business would be trending toward being more overvalued currently. Keep in mind that a discounted cash flow model is really predicated on the predictabilities of a business's future free cash flows. And while AT&T's core business is a pretty fixed asset that's been in place for a long time, the company has done quite a bit in terms of mergers and acquisitions. That's been a major piece in the business's history over the past 25 or 30 years, which oftentimes have led to some pretty lackluster results, and that's shown up both in their overall business and in their returns to shareholders as well. But again, please be mindful of the fact that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. So in just a minute, we'll talk about our summary for AT&T, but we have to address something first. What are some of the qualitative aspects of this business, especially those that support the key points for either a potential long or a potential short thesis of AT&T? So starting with some of the key points around a potential long thesis for AT&T, Number 1, combining wireless and fixed line networks with new technologies and deep expertise makes AT&T a force in enterprise services. Number 2, AT&T has the scale to remain a strong wireless competitor over the long term. With 3 dominant carriers, industry pricing should be more rational going forward. And number 3, following a period of investment, AT&T will hold a nationwide 5G wireless network with deep spectrum behind it and a fiber network capable of reaching nearly 1/4 of the United States. Then for some of the key points around a potential short thesis of the company. Number one, AT&T's massive debt load will catch up with it. Even after spinning off Warner with a huge amount of debt, AT&T carries far higher leverage than it has historically, and its dividend payout remains high. Number two, advancing technology will eventually swamp AT&T's wireless business, enabling a host of firms to enter the market, further commoditizing this service. And number three, the cost of maintaining dominance in the wireless industry by controlling spectrum has been exceptionally high over the years. AT&T has spent $40 billion over the past 3 years for licenses, with few prospects for incremental revenue. So hopefully that offers a potentially balanced perspective around some of the key qualitative aspects of the business. Now it's time for our wrap-up. So in summary, AT&T was close to not having any checks today, although way at the end the company overcame the odds to go 1 for 6 on our Select 6 analysis today. This was because their average free cash flows to their enterprise value looked like they're potentially attractive relative to the yield of the 10-year treasury, and they'd be potentially offering a slight risk premium. However, that risk premium didn't look like it was present based off of their current free cash flows. AT&T also has more net debt than what their market cap is worth. Their earnings, free cash flows, and revenues are down over the last 5 years, and they've diluted existing shareholders by about 5%, and the business only earns about 7% average returns on capital, which are right about those returns of a typical business. While AT&T does have a 5.6% dividend yield, and it looks like they have done some work to right-size their dividend in recent years by cutting that over the past year, it looks like there's potentially more work for the company to do, even though their dividends are well supported by their free cash flows, really due to the very high debt load that the company employs. Then finally, performing a discounted cash flow analysis of AT&T. If you've done the work and you believe that those historical growth assumptions are going to be accurate and applicable going forward for the company over the next 20 years, then it looks like a potential fair value for AT&T at today's valuations is just about $11 per share. That would be down about $9 from today's current stock price, down about 45% from where the business is at today, and down even $3 below what their 52-week low was. It's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with your financial advisor. This analysis instead serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about AT&T. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $119. That's just 33 cents per day through my referral link down in the description below. Normally premium is $239, but if you use my link, it's 50% off. So check it out if you're interested. So as a value investor, you're ultimately trying to conduct this research as if you're going to own 100% of a business, and you can truly understand that company's underlying essence and understand what's important and what's not important for the business going forward. So through this deeper research, you'll learn more about the qualitative and the quantitative aspects of AT&T, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for AT&T will be. So with that said, that's it for today's fundamental stock analysis of AT&T Inc., ticker symbol T. Again, we looked at the business today as a subscriber request, so I'm happy to make an analysis of the company. And if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about AT&T with me, and have a great day.